ladies and gentlemen, strap on your seatbelts and hold on to your kombuchas. It's time to get ready for the real estate revolution.
Well, I can tell you one thing, I'm ready. Welcome to the Real Estate Revolution podcast. I am Kip Lohr, your host with Lohr Real Estate, and I have in the studio today Ryan Neal from our Eugene office. Welcome back to the show, Ryan Neal. How are you today?
I'm swell, Kip. How are you?
You know, I can't complain. I'm really excited about this week's topic. Last week, we were talking about we're in 2022. What does that mean for people looking to buy or sell real estate in our local markets of Bend, Redmond, Eugene, and Springfield? We were talking about interest rates. We were talking about inflation. We're talking about inventory, buy low, sell high. Oh my gosh. Well, this week, we're going to bring in a special guest from Mortgage Express. His name is Brad Tawzer, and he is going to wow us with his local lending knowledge. But before we do that, I think we should probably get to this week's market report. What do you think?
Sounds good, Kip. So without further ado, here's our weekly market update for Bend, Redmond, and Eugene, Springfield. So through the first week of February, we're seeing some pretty interesting numbers. We mentioned during our last episode that Bend's market hasn't exactly been cooling down, which is normally what would be happening this time of year. And as we're seeing at the beginning of February, not only is it not cooling down, we're actually seeing a ton of buying activity, and prices, at least on properties that have gone pending so far in February, are up an incredible amount. So just the first week of February, we saw 70 homes go pending. That's a higher volume than average for this time of year, and it's all the more remarkable given Bend's incredibly limited inventory right now. So today, which is February 7th, there are only 127 properties currently active in Bend, 125 residential properties. So 50 homes, on the other hand, have been listed so far in February. That's less than we've had pending sales, so that means inventory is crunching even further right now in Bend. Now, a week is a pretty limited sample size, and things should normalize somewhat from here. But there's one other number that stands out from our numbers for the week. 34 homes have sold so far in Bend at a median of $723,000. So that would represent 5% appreciation month over month. Pretty high. Again, it's too early to draw conclusions, but we'll be keeping an eye on things in Bend. If these trends do continue, 2022 could easily be a repeat of last year when Bend's market went up 26% year over year. Now, in Redmond, the situation isn't nearly as drastic. We're seeing pending sales about on par with new listings and sale prices that are actually down a bit month over month. But we'll be keeping track of things there, too, as the month progresses. So moving on to Eugene. Through the first week of February, we have some relatively modest sales numbers. There were 28 of them at a median of $433,000. So that's lower than last month's median of $440,000. And again, we've got a small sample size here, so nothing really to write home about, right? Pending sales tell a similar story. We've had 49 of them in Eugene so far in February, with these homes listed at a median of $384,000. So that number is pretty low, but let's chalk it up, at least at this point, to coincidence. Prices do not appear to be falling in Eugene. At present, there are 109 residential properties currently on the market here, and the median ask price for these properties is $492,000. That's a lot higher than that $384,000 number. So what seems to be happening is that properties at the lower end of Eugene's market are getting grabbed up, but buyers in the middle and upper ends of the market might be waiting until later in the season to really start shopping for homes. Meanwhile, we're seeing listing activity. It's been a bit more robust than buying activity. 62 new homes have come on the market. That's compared again to 49 pending sales. So inventory increasing slightly, still super low though. So while Eugene isn't seeing the same early buying rush that Bend is right now, it's probably only a matter of time before, buyers really start to hit the market, and, inventory is still so tight here. There's going to be a lot of competition. It's a pretty similar story right now in Springfield. There were slightly more listings there in the first week of February than pending sales. But again, inventory super tight. So that's all for our weekly market update. Let's move on to the main part of our show.
Welcome back to The Revolution. My name's Kip Lohr with Lohr Real Estate, and you are on the Real Estate Revolution podcast. And we are at the portion of our show where we're going to bring in a guest today. And his name is Brad Tawzer with Mortgage Express. He is a lender that has offices in the Bend Redmond area and also the Eugene Springfield area. And I'd like to say, welcome to the show, Brad.
Thanks for having me. Happy to be here.
Great. So our last week podcast, we kind of got into the 2022, what's going to happen in the real estate markets, both in the Bend Redmond and Eugene Springfield areas. And, that's the big question for people rolling into the new year is interest rates are going to go up, and are we going to see more houses available? Or am I going to be able to buy a house? And I thought I'd bring you on the show today and, talk about answering some of those questions in 2022 through the lenses of getting a mortgage, getting a loan to buy a home. There's lots of people out there that are going to be looking to do that this year. And I thought you were going to be a perfect person to share some great information. I can't remember exactly, but how many years have you been in the business?
22 years.
Man,
going on 23.
Wow. Okay. Well, you look like a young man every time I see you, so I can't imagine that you have been in it that long. So,
I appreciate that.
Well, that's, you got to give a little flattery out of the way. I promised you beers and flattery.
True.
So thanks again for coming on the show. But so
my pleasure.
I think, one of the big, nationwide questions are, what are interest rates going to do this year? And, people are reading about inflation going up, and the Fed's got to pull its levers to get that under control, one of which is going to be raising, rates. And you and I both know that it's not that simple. And I thought maybe to start out, we would just talk about kind of some of the levers that the Fed has to get inflation under control and how pulling some of those levers might affect, people's ability to get a mortgage or what interest rates are going to be. And then we can just roll from there.
Well, to put it simply, the Fed tries to either raise interest rates or lower interest rates in order to either slow down the economy or speed the economy up. So all they're doing is trying to change the interest rate that affects what commercial banks borrow money for.
Okay. And so when there's this talk that rates could go up 1.75% or 2% at the Fed level, how does that trickle down to what you see rates doing this summer and into the fall and maybe by the end of the year?
Yeah, that's always a tough question to answer, just because it is something that it kind of indirectly can affect mortgage rates. And mortgage interest rates are most closely tied to what would be referred to as the Treasury, but specifically to what's called a mortgage-backed security. And it really just depends upon the popularity to investors on what will affect either the increase or decrease in mortgage interest rates. And historically, they are going to just automatically start to increase a little bit, just as the home buying process, increases as we go into the buying season, i.e., in the spring.
That makes sense. So, like the stock market kind of reacting to just even the talk of slowing down the flow of money, the reaction happens before the actual action happens, right?
That's correct.
Yeah. So, I think you and I were talking about this a few days ago, but the buzzword of interest rates and people's ability to qualify for a loan and what the affordability of borrowing money is right now, they always tie it to the interest rate. And you and I both know that the picture's much broader than that. And there's many other things that go into, people's ability to qualify. And I thought it'd be interesting for you to kind of touch on a few of those things.
Well, it really boils down to the affordability, and what determines the affordability of the homes in any particular area is what we refer to as, the debt to income ratio. And so it's not just about interest rates. It's not just about the price of the home that you're looking at. It really is, what is it in relation to what your monthly income is and what your monthly expenses are. So we don't ever really focus on, hey, what are current interest rates, because that's only one determining factor.
And so it's easy to just jump on the interest rate and say, well, of course I want to get the lowest interest rate. And that's all I need to know. And so, having a professional that can guide you in the other elements of this decision-making process and be able to help you understand that, like, oh, there's way more to know than just what your interest rate's going to be. And
there's a lot of other facets to it. And it's easy to talk about interest rates because that's something that you feel that you know about, because you've heard about that, and then that makes sense to you. So let's just talk about that. It's like, well, we can talk about that, but let's talk about the other things that are affected throughout the process too, to make sure that you're still making the correct decision.
Yeah. And what I tell people is that if the goal here is to purchase a home, then we need to focus on how we can get you there. And, the interest rate is part of that, but it's only one small part.
Only one part.
It's only one.
Exactly.
Yeah. And so to be able to understand all the other things that can become either a gateway to you being able to realize that goal or an impediment, you need somebody who's going to take you through all that process.
Yes, exactly.
One of the things I find interesting is, we get our clients set up with a lender such as yourself, and you qualify them, say, for a $500,000 purchase or a purchase price of $500,000. And obviously their down payment and whatnot can be different. But I find it interesting that folks think that now they're going to go out and look at every $500,000 house out there as if they can buy that's, just any $500,000 house. And that's really not the case.
Well, each property is unique. Each property has its own special expenses, and depending upon property type, well, as an example, if you're looking at a single family residence, it may or may not have any homeowner association dues.
Right.
If you were to look at a townhouse or a condo, that is most likely going to have homeowner association dues. And so there are some, townhouses and condos, for instance, that the amount of monthly homeowner association dues can equal, almost $100,000 worth of buying power to a single family residence.
Right. Which would be different depending on the amount of services that they're providing, some of the HOAs. Yeah. And the thing that's difficult about that is that, so back to, well, this isn't your front end, back end isn't calculated on your garbage bill and whatnot. Well, I mean, a lot of these HOAs include, the insurance, the property, the hazard insurance and utilities and snow removal and yard maintenance. And so, on one hand, a buyer may look at that and say, well, I'd have to spend, that extra $200 on these things anyway, so I should be able to afford the place. But from a qualifying standpoint, that doesn't help them, right? It becomes a hindrance for them.
That's correct.
Well, so give me some other examples of things that you find are kind of the misnomers that people come into your office and feel like they know what they're getting themselves into and then run into problems down the road.
Well, that really varies from client to client, but I would say that the lending process isn't as difficult as some may think, especially for first-time home buyers, because it is relatively a simple process, and it's just a matter of verifying income and assets. But the most important thing about say having an initial consultation is just to make sure that there aren't any questions that, you may have or misconceptions that you may have, and just sit down and, kind of talk through them. And I think that it would be a lot less scary process than you may think. But there is one thing that I try to make clear is that the lending process is somewhat of a living organism, and guidelines will change. Risk factors change. So, as an example, as we've gone through the last, say, 24 months, when we had some of the forbearance requirements, well, automatically that's going to change some lender requirements that have to deal with, are you currently in forbearance or not? And so that is definitely something that would have changed, say, over this last short period of time than would have been different from 5 or 10 years ago.
Right. And it's true, just like with each property, they're kind of, each one has a life of its own and different qualifying factors that come into play. Like the taxes on, your neighbor's house and your house may be $1,000 different, or like you said, you might have HOA fees or may not. But at the same time, when you're out there as a borrower, your particular situation about I guess here's a good one to throw out as an example. So we've got people that, because of COVID, are now able to be remote workers permanently. And so you as a lender, you've got somebody who's moving up from the Silicon Valley, and their employment situation traditionally is, if they're working for Facebook, and they're moving to Bend, for instance, you'd be like, well, under normal circumstances, you're going to have to purchase this as a second home. If you're moving up here, how are you going to continue to work at Facebook? But now we've got a situation where people can work from anywhere in the country for many of the different companies, but they're going to have to be able to show that that their company's allowing them to do that.
Very, very good example. Because when you're typically working at a brick and mortar company, anything outside of 65 miles of commute time is considered, second home / vacation home. It's just that was kind of the standard that we went by. And as you're saying now, you can work remotely from anywhere, and so that requires just some additional documentation, provide proof from your employer that you are able to work out of state remotely.
Right.
So,
right. You were mentioning to me the other day that they're starting to create some self-employment category. Back in the day, we had loans for folks that were self-employed, and after the market crashed in 2008, basically all of that became very difficult as far as qualifying people that were self-employed. And so how is it for people that are self-employed these days as far as qualifying for a mortgage?
Well, during the last, couple of years, it actually had become a little more difficult again for self-employed buyers. But here just recently, over the last, week and a half, some of those requirements have, loosened back up from what they had, back to where they'd initially been. So that has changed back. But over the last couple of years, you have the self-employed buyers, just because of so many, small businesses struggling with the lockdown.
Yeah.
It had become difficult again for a self-employed buyer to, deal with some of the documentation. But some of those guidelines have just recently been removed.
So not quite stated income like back in the day, but they're getting more back in line with what they were doing maybe 3 or 4 years ago. Is that what you're saying?
Yeah, and and to kind of cover the stated income thing just a little bit, because I know has always been a little confusion about that, and basically stated income was just a self-employed borrower or buyer being able to go off of the gross income rather than the net, and that's basically what a W-2 employee does, right? You're able to qualify off your gross income and not after tax amount. And yeah, that made things a little bit more difficult for sure for self-employed buyers over the last few years.
So what is your recommendation to folks that are self-employed as far as getting more qualifiable if they take the time to give that some forethought and get ready to have the kind of documentation that they need to be able to qualify.
Yeah, that's always difficult because, obviously self-employed buyers are, paying taxes based upon their net income, which then can become also what makes it difficult to qualify for a home loan. So they definitely want to talk to their tax professional to see what is the best plan of attack to thread that needle.
Right. So in other words, if it doesn't show up on your tax return, you don't get credit for that income. So you got to be able to, if you're not paying taxes on it, you're not gonna be able to show it as income.
Exactly. So sometimes you almost have to pay more in taxes in order to make your tax returns be where they need to be in order to qualify for the loan that you want to qualify for. So it just takes some pre-planning sometimes.
Yeah, that makes sense. So before I let you go, one of the things that we do every week in our show is we do a segment called Kip's Tips. And this week's tip, I'm going to be talking about working with local lenders and the importance of that in standing out in a multiple buyer situation. Mm-hmm. And so I'm going to give my perspective on that a little bit later in the show, but I'd be interested to hear kind of your take as a lender, as the importance that you see to working with a local lender. What's the pros of working with a local lender versus, say, one of the online lenders that are kind of national lenders where you're not actually working with a person within, your city or your state?
Well, as an example, just within, say, the state that we're calling from at the moment, there are differences, from county to county as far as expenses go. And unless you are familiar with some of these things, then some of those things can be missed and they can show up last minute as a surprise. And so there's just no way for out of state lenders, for instance, or national lenders to know all these different idiosyncrasies. Say for example, Washington County has what's called a transfer tax. And if you're calling to get a quote from an online lender to see how much money it's going to cost you for closing, they're 9 times out of 10 they're going to miss that.
Got it.
And so having a local lender, you're going to assure yourself that all the things that you need to know are going to be known up front and not become as a surprise later on in the transaction.
That makes sense. So what you're saying is that you're required to have a disclosure period at the beginning of the loan process and the end of the loan process. And the beginning of the loan process is easier because you're at the beginning of the loan process. You get to the end and you got a close date. We often get jammed up right to the edge of that. And so if the numbers aren't right, when that disclosure happens, it can, force a transaction to not be able to close on time. Is that kind of one of the things you're talking about?
Or not close at all.
Or not close at all. Yeah. Well, that's not a good thing. What would be another compelling reason that you would put out there to work local versus, like you say, the online or national lenders?
Well, no one can close a transaction on their own. Everything takes a group of people, a team.
Yeah.
And knowing the local closing agents, for instance, it makes a big difference when you can be directly involved with the other people that are working on the transaction, and the main thing is being able to be available. Not just as a 9 to 5 person, but also evenings and weekends. And it does make a difference because, things do happen outside of your standard work hours.
Yeah. Banker's hours just don't work anymore. None of us can work those. And
No.
I agree with that 100%. And I would also throw out there that more often than I would like to admit, we end up getting into a situation where, right, you call in a marker where you say, man, can you really help me out on this one? We're not going to be able to close on time, or we're not going to be able to close at all unless, you can pull a rabbit out of the hat for me. And when there's a relationship there, you can call in those markers and maybe get a deal done that wouldn't get done otherwise with a company where there's just no relationship there. You're kind of on a conveyor belt, and you either go down the conveyor belt and, close the loan, or you get stuck, or you fall off the conveyor belt and kind of nobody cares.
Believe it or not, relationships do matter. And if you know the person that you're working with and you need some help, they'll pick up the phone. Not so much if you don't know. That's just human nature. It's the way it works.
Yeah, and I always tell my clients, I like to know that I can walk into your office and pound my fists on your table, on your desk if something's, going wrong. And that's kind of the other side of it is, being able to, have that proximity to really know what's going on. But
very, very true.
Very true. I really appreciate you joining the show today. How do people get a hold of you, Brad? They need to borrow some money to buy their dream home. How do they get a hold of you?
Very easily. Direct line, 541-948-7295. I can be reached at any time.
Okay. And you want to give out an email address so they can fill out an application?
Email address is btawzer@mtgxps.com, or just look me up on the web at Brad Tawzer.
Well, I really appreciate you coming on the show today, and I think we're going to have you on again.
Oh, that would be fun. I appreciate it.
All right. Well, you have a good one, Brad, and we'll catch you next time.
Yeah, thank you.
Welcome back to the Real Estate Revolution podcast. I am Kip Lohr, your host with Lohr Real Estate, and our final segment is some tips for buyers out there in the form of Kip's tips. Today's tip is use a local lender, go local, and here are several reasons why you want to go local. First and foremost, you are going to be out there bidding with many, many other buyers for the same home. And how are you going to stand out in a crowd? Well, one of the ways you can stand out in a crowd is work with a local lender that will instill confidence that you can get the job done. Lots of times with the online and national lenders, they aren't there to answer questions. They are hard to get a hold of. They may be working banker's hours of Monday through Friday, 9 to 5, and you need somebody who's going to be in your corner, that is going to be reachable and is known locally for getting the job done. So accountability, you want somebody that if something's going off the rails a little bit, that they are going to make sure that they are going to get it back on track for you, because of relationships that they have with the community. Local know-how, they're going to be able to understand the local taxes and fees that are associated with the particular city or county that you live in, to make sure that that at the end of the day, there aren't going to be any last minute number issues as far as how much you need to do, come into closing with fees and whatnot. Communication, they're going to be available. You need them more available. You need to be able to pick up the phone and know that they're going to be there for you. And finally, you need to have the confidence that somebody is working in your corner and has relationships with the community and with the other agents in town. There you have it. See you next week.
Thank you for joining The Revolution. We are over and out until next week, when we'll continue to fill you in on all that matters most in our local Bend and Eugene real estate scenes. See you next time on The Real Estate Revolution.